A very good afternoon, good morning. Welcome to our FX Week Ahead live market analysis with myself, Giles Coghlan. I do hope everybody is doing well. Good to see you. Brian, CN, good to have you. Danny, Setley, Suneth, Alexandro, very good to have you. Very warm welcome as well, particularly if you were able to pop into the Dubai Forex Expo. I was there last week, so it was nice to see a couple of friendly faces who attend this seminar, who were able to pop in, obviously living in Dubai, so that was excellent. Hope everybody's doing well, and yeah, thank you very much, CN. Yeah, we have seen a bit of action from the Bank of Japan, and we'll be covering that, of course, during the session. Just as folks are coming in and signing in, don't forget, as we look at the FX Week Ahead, the whole idea of this webinar is not that it's a signal trading service. The whole idea of the webinar is that you see how I go about understanding the markets from a professional trading perspective, understanding sentiment, understanding the overall risk mood, how that translates into potential trade opportunities. We'll be going through a couple of opportunities that I can see in the market, both short and long term. Just as folks are signing in, I'm going to go over to the main screens. And you know, on a week like this, what I want to do is I want us to start with the overall risk tone. And the overall risk tone is leaning risk on this morning, but it's a very mixed risk tone. So what I want to do is I want to lay out where we are in the big narrative, because it's very important we don't get lost in these big narratives, okay? We need to keep absolutely focused on the main events. So, looking at equity markets, we had an interesting development. We had two interesting developments over the weekend. So first of all, we had an indication from Federal Reserve's daily, who kind of hinted that the Federal Reserve may not need to hike by 75 basis points at the November meeting. He was sort of saying it could be a 50 basis point hike. Now, this was the first kind of Fed speaker we had stressing concerns over slowing US growth. Now, you can see that equity futures markets in the US rallied higher quickly on that move, and they're trying to move higher as we speak now. So we've got a more positive risk tone, and we could see some extra moves higher in US equity futures. But I'll tell you why it's mixed. Because overnight we had some pretty negative sentiment out for China. So the data was very mixed over the weekend. If we just look, and let's just take that weekend data as well for China, we'll see, you know, a very mixed kind of print that we had. We had GDP came in high, 3.9% year on year, above the 3.4% expected, excellent. Industrial production, excellent, above the 4.5% expected. But unemployment was high, 5.5%, and the retail sales were lower. Let's just find where those retail sales are. Here they are, 2.5% versus 3.3%. So a mixed picture, and markets are quite concerned about President Xi. He's advocating a pivot towards common prosperity, which is a more communist-heavy ideology, and that's not necessarily so good for free markets. And that's why investors in the West are quite nervous about investing in China. Do you remember last year or earlier this year, we had interventions and intervening operations from China over, you know, gaming companies, and certain Chinese companies suddenly found themselves having to do what the state wanted them to do. Now, from an investor's point of view, do you want to invest in a company that has the risk the state will suddenly say, you know, we've got a different mandate, so we have to give you new priorities based on the government's mandate, not on free market principles? And that's what investors are a little bit worried about. And President Xi is making that shift. On top of that, President Xi is also keeping to that China COVID zero policy. Now, the China COVID zero policy means large cities are locked down, and as a result of these large lockdowns, then economic activity is quickly subdued. So that's why we're seeing China's 50 moving significantly lower on these announcements. Now, that has been that was more negative for sentiment to start, but I hope you can see in the big picture things. Yes, CN, thank you. Control and reduce reforms. That's it, well put. One thing that we can see from the start of the session is it's a bit mixed, because on one hand, you got Fed's daily indicating the Fed may slow, so that should be positive for risk. But then you've got this more negative outlook for China, which is more negative for risk. So although risk is leaning positive at the moment, it's very tentative, and they're the big pictures that are actually driving equity markets at the moment. Now, in terms of commodities, we can see that gold and silver have been just pushing a little bit lower during the session, as the dollar has found some strength in this session on safe haven bids, which is what you'd expect with the more risk-off morning. Copper is pushing lower, oil is pushing lower. So although the market is tilting risk on, we can see commodities are showing a more risk-off footing as we start the US session. Bond yields are subdued, finding a little bit of strength now, but generally being pushing lower. Now, in the current market environment, that has been more positive. And you can see that 10-year yields over the Friday, when we had a more dovish outlook coming from Fed's daily, we sort of saw this sort of reversal in yields and expectations of lower interest rates coming from the Federal Reserve, which has just been supportive for stocks. So no major moves in the bond market. UK bond yields continuing, the yields continue to push lower on news that Rishi Sunak is expected to be Prime Minister unless Penny Mordaunt can get 100 votes. I think she's got 90 votes at the moment. And if she did get 90 votes, then it would be a head-to-head against Penny Mordaunt and Rishi Sunak. If they would then be sent to Conservative members, and then either Rishi or Penny would be given the Prime Ministership of the United Kingdom by Friday. At the moment, as things stand, unless Penny Mordaunt can get 100 votes in by 2 o'clock today, unless you can do that, then it's going to be Rishi Sunak. And gilts pushing lower shows that the market is broadly happy with the prospect of a Rishi Sunak, so that's mildly pound positive. The yen, the yen, the yen. Now, on Friday, we had intervention from the Bank of Japan. Now, although it wasn't officially announced, that intervention, you see how incredibly similar that is to the intervention that was confirmed at the end of September. So there's no doubt in my mind that this was an intervention from the Bank of Japan. And you can just see, when we were looking at just trading the break of the trend line, you know, that trend line break would have been a very effective trade, and just going, you know, for 100, 150 points would have been a very nice trade. I didn't trade it because I was traveling at the time, coming back from Dubai, and actually got a text message from a Reuters journalist who was asking me about it just after I landed. Was it an intervention? This, to all intents and purposes, is an intervention, and this looked like another little intervention this morning. So there's no obvious trade here. My suspicion here is that the Bank of Japan saw these more dovish comments from Fed's daily and Fed whisperer. There's a Fed whisperer tomorrow who also indicated the Fed might be sort of slowing down. I think the Bank of Japan just jumped on that and used it to intervene, and we've had a huge strengthening of the yen against the dollar. There's no obvious trade here. If the Fed stay more hawkish, the obvious thing is just to buy the dip. But again, you just have to be careful where you put your stops, and the risk of intervention, that was enough to keep me out of going long dollar yen. So I didn't want to be suddenly hit with a 200, 300 point move lower, and particularly want to run the risk of slippage. Just be very careful of that. And, you know, once that move is gone, it's gone. And now the thing is to wait for another move. Dollar is sort of, it's found some more early strength in the session, but the dollar selling off from Friday makes sense on a more dovish Fed. So the pound has been pushing lower, and that is a decent area where the pound is at. So, you know, if you wanted a speculative long on the pounds at market with stops at 1.1180 would make sense, okay, and see if that could run higher. It's not a trade I'm in, but it would make sense from a risk reward perspective. You see you've got this nice bullish hammer reversal bar. We're now at the nose of that hammer. So if we did get, even a move back down to that 1.1250 would be great, and stops could be just the other side of that hammer reversal. But that's a very nice region to potentially looking at in the majors. Yeah. Now I'm speaking to BBC World Service at 2:30 on the pound. Now, one thing that you want to notice about the pound, this is a response to CM's comment. CM correctly says, regardless of Prime Minister, the economic outlook is poor in the UK. It is. There's a number of, there's Brexit risk, there's a cost of living crisis, a weak pound has made inflation worse. We have significant cuts that are expected in public services in the UK, tax increases. So it's quite a bleak picture, and it's not very attractive for foreign investors at the moment. What with the cost of living crisis plus high energy, partly as a result of the Russian-Ukraine crisis, plus the Brexit risk. So it isn't, but you see a lot of that bad news is priced in. And yes, the pound has fallen, about 17% against the dollar this year, but the Aussie's fallen 16%, New Zealand dollar's fallen 20%, yen fallen over 30% against the dollar, euro over 15%. So the best hope for the pound is going to come from the dollar. So if we start getting any dollar weakness, I expect the pound to recover alongside those major currencies. So look out for that going forward. You can see the dollar weakness coming in last Friday. Pound, again, you can see there is a little bit of recovery that's been chipping away at the index level. That's kind of, to be expected. I was jobbing the S&P 500 futures this morning, and I've stopped that now. But looking ahead, it wouldn't be unusual to potentially see some more upside in the S&P. If someone put a gun to my head, I wouldn't be surprised to see a little bit more upside in the S&P 500. We have moved higher up through that break of that trend line, and it wouldn't be surprising to see, prices keep moving higher during the session. But just need to be alert. Not a trade I want to be getting into because of the mixed risk profile. So I want to wait for a better outlook. Now let's just look at the calendar and we'll see. So with that mixed Chinese data, we had a negative European data. No big surprise to see German business slowing down. We're expecting that, but below minimum expectations, but no one really cares about that. Everyone knows how bleak it is for the Eurozone. UK, again, below minimum expectations. UK in recession now, but again, everyone knows that already. It's no particularly new news. Got German IFO data tomorrow. Not expecting that to particularly move markets. US global services PMI will be important. If we see a big miss here, then you could expect to see some upside in gold, upside in silver, upside in the S&P 500. So a big miss on the PMI print coming in, sub 48.5, sub 50.5, sub 49.5 for those prints. I would expect upside in S&P 500 and would look at potentially going long, see if we can break out that overhead resistance for an intraday trade. Looking at consumer confidence tomorrow, that's the next one. UK, German data, again, unlikely to have much of a reaction, so I'm not looking at trading that, but the consumer confidence will be important. If we get consumer confidence dropping below 100, then again, I'd expect that to give more upside into the S&P 500, more weakness in the dollar, and potentially if Rishi Sunak has been chosen as the UK PM, then I'd expect that to lift the pound US dollar. That could be a nice trade out of a very weak consumer confidence print. Likewise, if this is very weak and Rishi Sunak is confirmed as the UK PM, which we should know by 2 o'clock today, then that should lift the pound US dollar pair significantly higher. Wednesday, Australian data, CPI print. So again, anything that is tilting to the downside should allow the Australian dollar to weaken. But expectations have been growing for a sort of slower RBA. So I think the best opportunity would be if the inflation data comes in very hot. Say it comes in above 5% for the year-on-year print, and let's say the year-on-year headline comes in above 7.3%, then I would expect the Australian dollar to gain against the dollar. So if the risk-on profile remains, then I think Aussie US dollar long or Aussie New Zealand dollar long on a bigger than expected hit. Now, if there's a miss, kind of markets have been starting to price in a more slowly, a slower RBA. So the best opportunity would come if it surprises to the upside for the Australian data. Now, CAD interest rate decision, that's going to be interesting on Wednesday. Now, just look at the CAD from a index perspective. Now, if you look at the CAD from an index perspective, and we're going to go onto the daily chart, what you'll see is that the Canadian dollar has been really on a rip higher. And the reason for the rip higher is that the US, Canada's largest trading partner, has been doing well. And it's mainly been monetary policy from the Bank of Canada continually being more hawkish than the market was expecting. That's allowed for the CAD to keep pushing higher. So what I'd like to see for a tradable opportunity is if we had the interest rate decision come in at 3.75% or lower, 3.5% would be ideal. I'd expect to see the CAD weaken rapidly. And I think I trade it against a strong currency. So potentially you could trade that against the pound. So a pound CAD long could make sense on a interest rate miss. If we saw risk off trading and dollar strength, the dollar CAD would be a good opportunity. Otherwise, I'm just showing another strong currency we've got at the moment. Yeah, I think they're the ones that spring to mind, pound CAD or dollar CAD. So I'm not really interested in trading a beat to the upside. I'd expect that to sell off. So even if we've got a 4.25%, I'd expect that to be faded. But a good opportunity would come if it comes in lower than market's expecting. Don't forget the press conference is coming 1 hour later. So you always have to watch when you get an interest rate decision with the press conference coming later that sometimes investors will wait for the press conference to either, initiate new positions or reverse positions. So, always consider these as two almost separate events that you need to be aware of. Thursday, you've got ECB decision. So very interesting. Markets are expecting a 1.75%, 50 basis points hike. Let's just have a little look at the short-term interest rate market expectations here. So just looking at interest rate expectation. Okay, so the terminal rate for the ECB is expected to be just under 3%, so pretty similar to what it has been. And you can see that the implied basis point for upcoming meeting is a 75 basis point hike. Okay, so that's 93% priced in. Okay, so if they hike by 100 basis points, you would expect to see some euro upside. Okay, so a 100 basis point hike is not really priced in, only 6% pricing for the ECB rate to be above 75 basis points. So 100 basis points, expect to be 1.75. So even if it comes in at 2, that's not going to be a surprise. It needs to come in at 2.25%. So if you get a 2.25% hit on the headline, then that should support the euro, and I would probably trade the euro. If the risk on tone remains, I'd trade the euro against the dollar. Euro US dollar upside would make sense. US data on Thursday. Now, what we want to see with the GDP is if the GDP is falling heavily, then that would be dollar weakness. So if Rishi Sunak is UK PM, pound US dollar upside would probably still make sense. Otherwise, euro US dollar upside, particularly if there was a more hawkish ECB decision. And then if the risk tone was on, you could potentially look at New Zealand US dollar upside or maybe Aussie US dollar upside. So what we're looking for here is a miss below the low, so the GDP growth rate is supposed to be 2.1% for quarter on quarter. If that comes in below 0.8%, then we'd expect that to send the dollar lower on expectations that the Fed will be less aggressive. Then got ECB rate decisions coming up later. We've also got core PCE prices. Now, what we want to see there is that lower. If that comes in below 4.3%, 4.2%, then expect the dollar to sell off quite sharply, and I would favor gold and silver upside in that environment. So quarter on quarter below 4.3%, and expect silver or gold upside for a nice scalp. Friday, got BOJ interest rate decision. Just look out in case the BOJ decide to hike interest rates. That's one of the easiest ways for them to hike. And you see, there's only 9% pricing of any interest rate hike. So if there is a hike, you'd expect immediate yen upside. So dollar yen short would be the go-to trade. So if they hike or indicate a hike, look for dollar yen downside. It would be a good potential opportunity. And then we have the core PCE data on Friday, very important print, and the Fed's preferred method of inflation. If this comes in below 4.9% for the year on year, below 0.4% for the month on month, I'd expect immediate upside in silver, gold, and US stocks. Then we've got consumer sentiment. That's the final reading for October. We've already had the preliminary reading. So again, a big miss to the downside would be supportive of gold, silver stocks. And I'm only favoring trading moves to the downside. If it's higher than expected, that's just what we've been expecting, right? That should be negative for stocks, negative gold, negative for silver. You may get a few points depending on, you know, what the market sentiment is at the time, but the best opportunity comes from this data missing to the downside. Okay. Yeah, CN just put watch interest rate differentials, and that's very important for the dollar yen, and that's what's been driving the dollar yen higher throughout the whole year, really, the interest rate differentials. So if we just take a look here at the dollar yen, you know, you can just see that dollar yen has been tracking rapidly higher, and if we put the interest rate differentials on between US and Japan, so here's the US 10 years minus Japanese 10 years, you will see how closely that they track one another. So do you see the yellow line is the interest rate differentials between the US and Japan, and you see that if that keeps tracking higher, then the dollar yen should keep moving higher. If this falls lower, then the dollar yen should fall lower. So just use that as a way to track. What result if yield curve control goes to 0.4 from 0.25? Yeah, I think it would be a similar kind of reaction. So if the yield curve control changes, and this is what CN is talking about with the yield curve control, let me just show you. So the yield curve control is currently set by the Bank of Japan to be at 0.25 to minus 0.25%, which is this band here. So what the Bank of Japan do, whenever yields go up to this level, they buy unlimited bonds to keep it pegged. Now, what they might do is they might push that yield, that target a bit higher, and say, well, we'll let yields go, we'll let the bond yields go up to 0.4%. Now, if they do that, that should allow the yen to strengthen. So you'd expect dollar yen downside. What I also expect is I think markets would probably try and test the Bank of Japan there, right? And if they move the peg, then they'll try to get it to move to 0.6. So it'd be interesting. I could see, you know, remember the Swiss National Bank? They were defending that peg on the Euro Swiss franc for ages, and then all of a sudden they gave up defending the peg. So just watch out for a capitulation. That's the best opportunity. So if the Bank of Japan say, you know, I'm going to hike interest rates, abandon yield curve control, then expect the dollar yen to sink, you know, 500, 600 points in a day. Yeah. Okay, folks. Right, that's it. You're ready. I'm back on Wednesday, and what we'll look at on Wednesday, we'll get ready for the bank calendar meeting. Okay, so come back here on Wednesday. I'll get us nice and ready for the bank of calendar meeting, and we'll also have a look at the rest of the calendar events heading into the end of the week, so we're completely ready. It's good to be back. Good to have you here, and I'm looking forward to take Highest probability trade. Right, long term, I do like copper, Cian. Long term, for the next 2 to 3 years. There's a lot of demand building for copper that's not there at the moment because of the slowdown in global growth, but supply is shrinking. And I did read a Bloomberg report. I'll have a piece up on my blog tomorrow, blog.hycmlab.com, that copper supplies in China's warehouses are really falling. So as soon as risk turns positive and people want to get hold of copper, they're going to struggle to. So copper, medium term, is my highest probability trade. It's a long-term trade. Otherwise, what I'll be doing is I'll be trading these decisions that we outlined today. So the best data, the highest probability trader comes from a miss in the US data this week that I've outlined today. And it will be like gold, silver long, dollar weakness, could be pound US dollar long, and could be S&P 500 longs. So that's what I like most of all this week. Yeah, wait until recession hits with demand destruction. That's right. And once that hits, once you get the worst possible news, when everyone's very negative, that's the time that I'll be looking to load up on copper. Folks, thank you all very much. It's been an absolute pleasure. CN, thank you for your comments as always. The rest of you, good to have you here as well. Setley, Ignatius, good to see some friendly names. Danny, Suneth, Brian, good to have you, Alejandro. And look forward to being back here on Wednesday. Take care and look after yourselves. Thanks everyone now. Goodbye.